All right, everyone. Hey, good morning. Welcome to what? It's the fourth already. The fourth of 2017. My name is Kevin Hurley. I'm filling in for Jeffrey Dunyan today. He is out having surgery on his ears, believe it or not. So, with that said, it's going to be a rather quick class. Only 4 trades we're going to go over, but I am going to go through some understanding of the strategies that you're using and why. I'm going to try to make it, instead of just going through it all in 5 or 10 minutes, let me spend a little bit of time going through the strategies and why they're so important, and a couple things I've learned trading these different strategies. As always, don't forget, this chat is a production of Safe Option Strategies, and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this chat is for educational purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks or options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All open positions discussed in this chat session are in a virtual account. No real money positions are discussed. We have a bull call calendar on for Nike. If I can go over and ask you a couple questions, looking at that chart, do we have the correct trend for this position or this strategy? One of the most important, obviously, parts of trading is to put the correct strategy on the correct trend. Looking at that chart on Nike, do we have the correct strategy, a bull call calendar, for the most current or the most recent trend? All right, we had a yes that came in. And let me get this out a little bit more. Rudy Y. Rudy, tell me really quick, looking at that calendar, looking at that chart, why would you say a bull call calendar on Nike is a good position to be in and that this is the correct trend? Okay, well, the 5 crosses the 20, but that's bullish, right? Well, Kevin says a bull call calendar. All right, I'll buy that. Looks sideways around 50, 52. So, Dan, what you're telling me is it's in a range. Right now, it looks to be slow moving, slow growth to the upside. It looks like it is slightly bullish. And it really does appear, or you could draw trend lines, channel lines, right around 50 to, in all honesty, 53. Right? Now, when I hear a bull call, in fact, if I can go over a couple interesting comments I've had, especially over the Christmas vacation, more often than not, I hear people talking about bull calls or bull call calendars, and what I hear is, oh, it's just not moving fast enough. On a credit spread, what's the primary objective of a credit spread? What's the primary objective of a credit spread? Theta decay. There you go. Perfect, Dan. It's theta decay. You're waiting for the decay of your credit. And notice I said waiting. You're literally having to learn patience. You want to collect all that credit. There you go. You're going to take advantage of time decay, which means you've got to do one of the hardest things in trading, and that is to be patient. Credit spreads are patience. In the money bull calls, patience. Bull call calendars, patience. Notice the theme I'm going over with. Right now on Nike, the trend is perfect for a bull call calendar. Well, Kevin, you said the trend is between 50 and 53. I did. With your credit at the 52.50, we can extend the trend and play 53 as a trend line. It has already bounced down off of it twice. 53 will be the trigger for an adjustment, most likely. We are in a great trend. It's an easy one to adjust. We just are looking for a continued movement within the current channel of 50 to 53. And the hardest thing to do for this trade right now is short calls out to February 17 is to sit back and be patient. Now, that doesn't mean you can't plan for an adjustment. If we see this break 52.50, someone tell me what would be your adjustment? Without even looking at an options chart, thinking ahead, hey, what am I going to do? What's my secondary exit? What's my adjustment strategy? If we see this break 52.50 or break 53, what is your adjustment going to be? What will your adjustment most likely be? Move the short call up. Perfect. In fact, you're going to roll that short call. Looking for a net credit, right? I would probably tell you you're looking at the $55 strike, and it could be in March or it could be in April. Why would I do 55? Well, if you're rolling for a net credit and or a slight credit with a net debit of $2.43, as Nike rolls up to 55, even if I was to get called out at that point, we'd be looking at roughly 100% return on invested capital, right? Your ROI, difference in spreads minus the debit, difference in spread 50 to 55 would be $5, minus your net debit of $2.43 or even maybe $2.50 right around that time period. I would know I could roll it up to 55, whether it be March or April. I'd probably go to April for more credit to roll for a net credit or at least a break even. And if I got called out at 55, I've just hit 100% return. I'm going to be in good shape. So when you're waiting, when you're doing that hard thing called patience, and you're waiting for the trade to go through, waiting for theta decay, waiting for the trend to trend in these, to stay in and remain these trend lines, it doesn't mean you have to sit there and be bored. Start to work your adjustment strategies. Hey, I can do this, I can do this, I can do this. Out of curiosity, without looking at an option chain, if we have a pullback in January, we've had what, 8.1 last year and a 7.5 the year before. We have a little bit of a pullback, maybe even a correction in January. We break that $50 level on Nike. Where would you roll your shorts if Nike turned bearish and moved to the downside? Roll down to 50. Dan, perfect. I do the same thing. I'd start at 50. I'd want to keep it right around 50 because I don't want to increase my margin, right? If you go below 50, you're going to have some margin that'll be used, some options margin there. Or it could be some portfolio margin if you want to call it that. So yes, anytime you move into a credit spread, margin is withheld in your account. I would definitely be looking at 50. And since it stopped at 49 last time, I now know, hey, my adjustment to the upside is to move it from 52.50 up to 55 in March or April. Whereas my adjustment, if we do have a pretty common or historically common pullback, January into February, I know I can roll my short call down to 50, and I can do that for a profit. Any questions on a bull call calendar right now on Nike? Going once, going twice. All righty. Let's take a look at ExxonMobil. Aha! ExxonMobil. In the money bull call spread. Caller also. Joe, you kind of hard for a bull call spread to do a caller. You could turn into a poor man's caller if you had significant pullback, knowing you'd be assigned at 50, which means you could add that long put in place. So yes, in fact, Joe, that would be a great, thinking outside of the box, that would be a great opportunity for Nike if you want to do a caller. Are you have a caller on which one, Joe? Right now we're looking at ExxonMobil. ExxonMobil, again, in the money bull call. It's much like a credit spread. When you're in the money, you're waiting for theta decay, time decay. On this particular one, we are now following the spread. I know before he was looking at a bear put strategy, trying to play resistance, and of course, ExxonMobil went above that. For an in-money bull call, we're looking really good. We're forming or consolidating at that $90 level. It seems to be support. We have long calls at 88, short calls at 90. We have, what, week and a half to go on this one, just waiting for expiration, time decay. Maximum reward is 40 cents. It gives you a 25% return on investment. The chart looks great. We're in a great position here. We're just waiting literally for 7 more trading days to happen for this to get our maximum return, our maximum reward, excuse me, a 25% return on investment. With that said, thinking outside of the box on this one a little bit, I know we originally started as a bear put and created a bull call spread because it broke that resistance level at $90. Looking at this trade right now, what would be your concern with ExxonMobil right now? There's a glaring red flag. So the price of oil, it's primarily based on the price of oil, and it got the bump above the resistance level because OPEC said they're going to cut supply to increase demand and price, right? But what else? Looking at this chart, there's a glaring red flag that tells you to be prepared to adjust. Can I give you a hint? Look down towards the bottom. Lose that and kid, they're going to increase supply. I know, it's kind of funny. OPEC says we're going to cut. Other people say, oh, don't worry about it. Don't worry about it because we're going to throw some more supply in there. Above the short now, Dan, we actually wanted above the short. That comes right down to basic options definitions. Our long call at 88 is the right to buy the stock at $88 at a certain price, $88 strike price, for a certain period of time. That's up to January, the third week in January 2017, options expiration. Short call, you're obligated to sell your stock at a certain price. It looks like it's at the $90 price for a certain period of time. It's also out to the expiration of January 2017. So, the fact it's above the short call now, Dan, that's a benefit to us. It's an in-the-money bull call. We place in the money with the stock trading above 90, treating this like a credit spread. We're just waiting for theta decay. David, MACD turned bearish. There you go. Pretty interesting, right? A precursor, the MACD, right now has turned bearish. Now, you'll see more crossovers on the MACD than you will on the RSI chart or on a 5 and a 20-day, 15 and 30, 9 and 20, whatever exponential moving average you're using. But we have a precursor that we have the MACD that just turned bearish a couple days ago. So, kind of interesting thought here, right? Uh-oh, we have the start of 1 out of 3 of our bearish indicators, typically a precursor, because it crosses so randomly or so often. Could be a little precursor to downward movement. We don't know yet, and this comes down to technical analysis, right? You don't try to outguess the market. Plain and simple, sticking to your discipline. You're going to wait until you have your 3 crossovers. I'm only pointing this out because your thought process is, okay, what do I do with such short term now in a debit spread? What am I going to do to make an adjustment here? My thought process is, hey, if oil goes down big, I know it's going to go down to 50, could even go down to $45 a barrel. I might try to cash out my bull call and add a directional long put. You know, Kevin, you could roll down some short calls and you'll do it for a profit. Well, that's true, but remember, looking at those long calls that are in the money, same strike, you will lose more on your long call than you will gain on a short call credit. So because we have such a short period of time, an adjustment, moving one of the legs one direction or the other on an in-the-money bull call might be awfully difficult. I'd be looking to add a position. In this case, it might be a February long put or even a March long put. And I would close this down for any profit or as much in-the-money long call intrinsic value that I could get. Any questions on ExxonMobil? If there's not, I'm going to go ahead. Now, how would a 91 straddle do as another strategy? Michael, I'm going to tell you not good. But I'm going to tell you not good because as I look at the chart, here's what I see. I see periods of time of stagnation. Well, Kevin, if oil drops, it can go back down to 85. And I agree, and I see that. And yes, in between these month periods of time, there have been significant movement upward or down. So you're going to tell me, hey, I'm going to play the news. I'm going to play the fact that Russia is going to bring more gas, or United States, or Libya, or who be it. When I'm looking at a strangle or a straddle, I like to see 2 to 3 month continuous movement one direction or the other. It's just the way I am. I would be a little worried about doing a straddle because you do see, especially in the last 6 months here on the 6-month chart, you do see month-long periods of stagnation. In which case, because unfortunately oil is a news-driven commodity right now, it'd be awfully hard to short against one of your legs on a straddle. Oh, you know, they're going to have this announcement. We're going to have this announcement. for myself, because it's news driven and it's not necessarily technicals or earnings or so forth, a double debit trade for me would be a little bit on the risky side, especially because I look at the chart and I see time periods of stagnation. So, Michael, it's not that a straddle is not a strategy that you can't use, that technically speaking, when it breaks out one way or the other, you should make some good money on it. For me, the chart doesn't set up where I would take that risk on a double debit trade. But again, that doesn't mean that your straddle, again, looking at the chart, you can make a great justification saying, hey, when it breaks out, it's got some significant movement, I can make my profit there. I agree with you there. I just don't like the chart set up for myself. But a good observation, Michael. Costco. This is a trade that's killing you right now, huh? Bull put spread. Nothing like putting on a bull put spread, watching the stock go into an overbought RSI position, right? And pull off of being overbought for a while. Not only that, looking at the chart, chances are it's it's going to go down and touch that median line, the 50 median line on your RSI chart. But here's the simple comment here. Right now, the trade is not in trouble. Yes, you got that same precursor, MACD is crossed. We've pulled off the overbought position on the RSI. We're coming off of, 105, one of those rounderish numbers, 100, 105. It's a strike price number, right? Strike price is 105, bounced off of it, we're heading down. It's a bull put spread. It's a credit spread. We're waiting for that theta decay. In fact, theta decay seems to be the word, or what am I trying to say? Theta decay today is a concept we're focusing on, right? It's a theta decay trade. Well, Kevin, short puts are at 160. Longs are at 157. Right now, this bugger's closing at what? 159.73. We breached the 160. This is a great learning experience. You can panic and close it out for a loss, or you continue to let theta decay work on this position. It can't go down much farther before you're going to be looking for an adjustment. The rally at the close yesterday is all that kept us sitting on adjustment yesterday. But any downward movement, and you're going to turn this into a bull put calendar, which means you can keep your short puts in place. You're going to extend out those long puts out in time, and you're going to give, you're going to give those long puts the opportunity to make some money as you see cost ahead to the downside. Now, with that said, kind of a precarious position because you've got a gap that sits at that 57-ish range, $157 range. And then you've got some support at 154. So it's in a tight range. That's why, as you take a look at an adjustment, you don't necessarily go directional, you run to a calendar. You run to a strategy that's going to fit a tight range moving stock. Precursor, what do we see down there on the MACD? What do we see down there on that MACD? We've already got those crossovers, and Michael just said 157 is around a 38.2 Fibonacci retracement. Pretty interesting. I would have thought it'd be closer to like that 16.6, Elliott wave retracement, so to speak. But But 57 could be a pretty good support level, especially when it hits a Fibonacci level. Herd mentality, right? All right, it's come down enough. Time to pile some more money in. Doesn't that look like a bull flag? Almost, right? Almost. If it goes down a little bit more and you have your top line descending a straight line across at that 158 range, yeah, you beat your bull flag. Eerily similar. Again, one of the hardest things to do is a little bit of patience. It does look like it's going to be in trouble. Doesn't mean you're just sitting back waiting to lose money. This is where you start to take a little bit of time and you plan your next steps. Again, I like the idea because you do have that support there. Turn into a bull put calendar. Turn into a put calendar. But I'd definitely be looking at a calendar because we seem to be narrowing up our range of where we're at. All right, any questions on Costco? If not, we'll go to our last trade. The diamonds. And right now we're sitting in the money bull call spread, just like a credit spread. We're sitting around and we're waiting for theta decay. Michael just pointed a quick comment. Earnings season is coming up, so we need to be aware of this. Very true. Very true. You've got to be aware of earnings season. By the way, how's my sound coming? Do I still sound okay? Joe just made a comment that, could I turn the volume up? I guess I could. But all right, here we go. Last but not least, in the money bull call spread, we're sitting on the diamond. Literally, we're just waiting for time decay. We've got 7 more trading days, not counting today. We're hoping for a push, right? A push up to above the a push up to above that 20,000 range on the Dow. So again, it's in a sit and wait. It's close, but we like it. It's holding. We need, again, 8 more trading days, 7 more after today. The worry is that we've come off of the overbought territory on the RSI. Normally, in my opinion, I've usually seen a pullback down to that median line to reach that thing. And we've got that precursor. MACD has crossed to the negative side. Good news is it looks like it's going to make one more run, or at least one more push up to test 20,000. If you ask me, it's an awfully small chart there, but I'm looking at a triple, maybe a quadruple top, and I would expect our market to come down. There's not a whole lot of resistance on the way down since we had our Trump rally there in November. So when we do head to the downside, we finally might have that long overdue correction that we've been waiting on for over 8 years, right? Corrections of 15% or more usually occur every 4.2 years. Here we are waiting for a correction. It's been over 8 years since we've had our last true correction in the stock market. So with that said, that's going to finish it up for the live chat trading, the spread trading chat today. Any questions anyone has in regards to any of these trades? Any questions anyone has in regards to any of these trades? If not, guys, I'm going to wish you have a great Wednesday. Glad I could fill in for you. I will be filling in for the live spread trading chat here in a half hour. So look forward to seeing you here in the near future. I'm glad that you had me at Substitute Forum today. Guys, take care. Make sure you study those strategies, and I look forward to talking to you again next time we meet. You all have a great day. Bye-bye.